Ladies and gentlemen, good day and welcome to the JB Pharma's Q2 FY26 earnings conference call as on 12th November 2025. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touch-tone phone. I now hand the conference over to Mr. Jason D'Souza, Executive Vice President at JB Pharma. Thank you, and over to you, sir.
Thank you, Sagar. Welcome to the Q2 FY26 earnings call of JB Pharma. We have with us today Nikhil Chopra, CEO and Whole-Time Director, Kunal Khanna, President Operations, and Narayan Saraf, the CFO at JB Chemicals and Pharmaceuticals Limited. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available in the Q2 FY26 results presentation that has been sent to you earlier. I would like to hand over the floor to Mr. Nikhil Chopra to begin the proceedings of the call and for his opening remarks.
Thank you, Jason, and welcome to all of you on today's call. JB Pharma delivered another quarter of a good performance with the business growing ahead of Indian pharma market. Quarter 2 saw overall revenues at 1085 crores, which is 8% higher than the previous year. Operating EBITDA, excluding non-cash ESOP, came in at 319 crores, up 12%, and net profit was reported 208 crores, which grew at 19% year-on-year. Our Quarter 2 FY26 gross margins increased by 200 bps to 68.2% versus 66.2%. Cost optimization efforts, favorable product mix, and price growth positively impacted gross margins. Operating EBITDA margin came at 29.4%, up 100 bps year-on-year, underscoring emphasis on improvement in profitability. Moving along, let me draw the discussion towards the domestic business. Our domestic business showed a 9% improvement year-on-year to INR 644 crores. As per IQVIA September Met data, JB Pharma is the fastest growing company among the top 25 companies in IPM. Over the past several years, we have consistently remained one of the fastest growing companies in the country. This is indeed a major achievement for our organization as a whole. Further, all our major brands gained ranks, with 3 of our brands now in top 100 brands in IPM. We have now 6 brands in top 300 in the IPM. The business continues to be driven by strong brands with key franchises outperforming the market. As per IQVIA Met September 25 data, the Rizal franchisee, that is Rosuvastatin franchisee, has crossed 100 crores in revenue. This is another achievement considering that in just 2 years, the franchisee has gone from sales of 66 crores in Met September 22 to a INR of 104 crores as per Met September 25 data. We now have 6 brands franchises, each demonstrating healthy and sustained growth. Moving on, let me address our international operations. Quarter 2 FY26 saw the business delivering 7% improvement year-on-year to a INR of 441 crores. This was driven by strong trends in our CDMO segment. CDMO business reported 20% year-on-year growth to a INR of 113 crores for the quarter. We have a robust pipeline of products lined up for our global partners, and our order book remains strong for H2 FY26. International formulations reported a revenue of 306 crores, up 2%. Russia markets recorded strong growth for the quarter, whereas our other markets stayed subdued. We expect growth to return in H2 FY26. More of that we'll talk in our Q&A. JB remains steadfast in advancing revenue growth while deepening its focus on the cost discipline and organization agility. Our continued emphasis on the domestic and CDMO segments will be instrumental in sustaining both top-line expansion and margin strength. With a resilient balance sheet and a culture rooted in the execution excellence, we are poised to navigate the future with confidence and steer the company into its next phase of strategic growth. I would now like to request Mr. Narayan Saraf, our CFO, to continue with his views on the financial performance. Over to you, Narayan. Thank you.
Thank you very much, Nikhil. Good afternoon, everyone, and welcome to JB Pharma's Q2 FY26 earnings call. Now, to take you through the financial update for the second quarter, revenues for the quarter were at 1,085 crores, representing an increase of 8% year-on-year. The domestic business to international business mix was 61% to 39% for H1 FY26 versus H1 FY25. The domestic business, formulation business segment reported revenues of rupees 644 crores with a growth of 9% year-on-year. And as per IQVIA March September 25 data within the IPM, the company maintained its outperformance with a growth of 12% versus the IPM growth of 8%. In international business, the segment reported a growth of 7% year-on-year at rupees 441 crores. International formulations grew moderately by 2% year-on-year to rupees 306 crores, and the CDMO category grew strongly, recording an increase of 20% year-on-year at rupees 113 crores due to good sales momentum. Revenue from the API category were at 22 crores as against 19 crores in the previous year. Operating EBITDA, which is excluding non-cash ESOP, by 12%, grew by 12% to INR 319 crores for Q2 FY26. Operating EBITDA margins increased by 100 basis points to 29.4% for Q2 FY26. For H1 FY26, operating EBITDA, excluding one-off impact in Q1 of rupees 15 crore due to merger scheme, grew by 13% to rupees 649 crores. Operating EBITDA margins was 29.8%, an increase of 110 basis points as compared to H1 F25. Gross profit margin grew to 68.2% compared to 66.2% in Q2 FY25. Cost optimization efforts, favorable product mix, and price growth aided the margins improvement by 200 basis points. Overall, overheads, including employee costs, were contained, which also aided operating margins. Finally, net profit increased by 19% to rupees 208 crores for Q2 FY26 and increased by 17% to INR 410 crores for H1 FY26. Excluding one-off impact due to merger scheme, net profit for H1 grew by 20% to rupees 421 crores, an improvement of 180 basis points. The operating cash flow in H1 FY26 were at 363 crores. Cash tax increased to 116 crores. The company's gross debt as of 30th September 25 was at rupees 7 crores versus 14 crores as on 31st March 2025. Net cash and cash equivalents, including investments in mutual funds, were at 939 crores as on 30th September 25. The net capex addition for H1 FY26 was 46 crores versus 49 crores in H1 FY25. We remain confident on a positive outlook through opportunities for the company and providing value to our stakeholders. That brings to my end of my opening remarks. I now request the moderator to open the forum for the Q&A session. Thank you very much.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star and then one. Our first question comes from the line of Tausif Sheikh from BNP. Please go ahead.
Thanks for the opportunity. My first business on the domestic business. Just want to check whether our domestic business was impacted to the new GST rates, and can you help us provide the growth of acute and chronic growth for this quarter to help this thing better?
With respect to GST, the business was not impacted at all. Whatever numbers you see are without any significant impact on channel for the GST as far as GST implications go. Overall, our growth has again outpaced the market. If you really look at Q2 numbers, the volume growth for the market was in the range of 0.5 to 0.7%, whereas our volume growth was close to 4%. And we have always kind of, maintained that the reason why we'll be able to grow above the market is because we'll grow at least 3 percentage points above the market with respect to volume growth. And that trend continues to maintain. Acute season was slightly muted, which has impacted our overall domestic growth for Q2, mainly impacting products like Metrogyl and Rantac. But beyond that, our chronic growth has been significant. In fact, our chronic portfolio has grown at over 20%. Some of our key brands like Cilacar T, Cilacar Plain has grown at almost 14%. Cilacar T continues to grow at 26%. Our Sporolac franchise has grown at 15%. Azmada is growing at 23%. So all our big franchises on the chronic segment are actually growing at 20% plus.
That's helpful. Second question on the export formulation. I think this is the second consecutive quarter we have seen a muted growth. Which are the markets which are leading this drag to this kind of growth? Can you help us understand?
So, if you look at overall our performance in the international market, let me first talk about which markets got us the growth. CDMO grew at a pace of 20% for the quarter. And equally, Russia business demonstrated a good growth of 20%, close to high teens for the quarter and H1. The rest of the world and South Africa, they showed the muted growth. But what we would like to state here that we have a good order book for rest of the world, and we should see high single-digit growth in H2 in rest of the world market, and South Africa also will bounce back, supported by the growth will continue to happen in CDMO and Russia.
That's helpful. I'll get back into you.
Thank you. Our next question comes from the line of Alok Dalal from Jefferies India Private Limited. Please go ahead.
Yes, good afternoon, sir. Just two questions. First is, for the quarter, we've seen India growth of 9%. This is slightly slower than previous quarters. Is it largely because of seasonality?
Yes, as we maintained earlier, largely because of acute season slightly be muted. Last year, Metrogyl, the overall acute season was quite positive for us, and Metrogyl as a franchise had also grown. So it's an impact of slightly higher base for some of these key legacy products. It's just a seasonal variation. If you compare overall volume growth and if you see the chronic trends, we continue to outpace the market.
And Alok will continue to grow, and Alok, Nikhil here will continue to outpace, like what Kunal told, will continue to outpace the market, and as compared to IPM, will continue to go by 300 to 400 bits better.
Okay, sure. And can you split the growth between volume, price, and new introductions?
Sure. If you really look at it from a Q2 perspective, as reflected externally and also in line with our internal trends, overall volume growth is for Q2 4% and price is 6%. And overall H1 volume is 5% and the price is 7%. Some part of volume includes our NI, but that's not significant.
Got it. And last question is on field force. What is the current field force strength as of September?
So currently the MRs are close to 2,400 active MRs operating on the ground. No significant additions over the last 4 to 6 months.
And our productivity is close to around 7.5 lakh rupees.
All right. Okay. Sir, if I look at the March presentation, so the field force strength was about 2,800. So has there been some attrition, about 300, 400 MRs?
No, I think that is including the managers, Alok.
Okay, this is on the ground, feet on the ground. All right. Okay. Thank you for taking my questions.
Thank you. Our next question comes from the line of Rashmi Shetty from Dolat Capital. Please go ahead.
Yeah, thanks for the opportunity. Again, a follow-up from for the export market. You mentioned that, South Africa and US, we have seen some sort of struggle over there, while Russia, which had seen slowdown in first quarter, has seen a good season this quarter, and that's why it has picked up. But what exactly in US and South Africa, the struggle is it related to any sort of pricing pressure or, delayed product launches or anything? If you can give a bit in detail, though I understand that in the second half we will be recovering. But what is the temporary issue over here?
Yes. If you look at South Africa, we have been, over a period of time, we have been diminishing our overall participation in the public market tendering. So that is the reason, and it takes time in South Africa as a market where we have been highly relying on public tendering. But still, this public tendering participation and the contribution to business couple of years ago was 65%. Today it has come down to 35%, and private has gone up. But we are looking at how do you propel up the growth in the private market. So that will come. That we are confident. US. But no pricing pressure. We don't take any price reduction in US. US has been a quarter where our last year base was high because of some supply would have been on the higher side, but it has been a trend. We do around $10 to $12 million business every quarter. So I think that growth will bounce back in quarter 3 and quarter 4 for US business. So not a worry.
Okay. And in domestic business, what kind of price hikes we have taken? I mean, the blended price hike for this year. We have already taken it, or we'll be taking it now?
So it happens product to product based on, when the price hikes are due for a particular set of brands. If you really look at our H1 trending, price growth is 7% for our domestic business. For Q2 specifically, it was 6%.
And so we continue to maintain our guidance of 12 to 14% for domestic market, expecting that the H2 will pick up due to the chronic segment.
Absolutely. As we have always maintained, we will continue to outpace the market. And even if you really look at the volume growth figures compared to the IPM, we continue to be 3% higher than the market volume growth figures, and we'll continue to maintain that. So we will be looking at 12 to 14% growth for our domestic business.
Okay. And last quarter, you mentioned that gross margin guidance would be in the range of 67%. You still hold that because we are running at 68% now. And similarly, if you can guide on the EBITDA margin, whether you're retaining your guidance of around 27 to 29%.
Yes, on gross margin, and we continue to maintain that we will be in the range of in that range of 67% to 69%, and EBITDA also very clearly we would be in the range of the earlier guidance which we had given, and we continue to see that we are tuned to achieve those guidances.
Okay. And just two more questions. If soft charges will get over by which year? And in case our optical portfolio gets consolidated, that is from FY28, what kind of gross margin improvement or margin we can see? Because our base business itself is now at around 29% EBITDA margin. So how much expansion can we expect from there?
On the Optal side, and Narayan can take the ESOP question later. On the Optal side, the perpetual license gets triggered in December 2026. So from calendar year 27, we will see a significant improvement on the overall gross margin profile. We don't want to significantly peg any number or give any guidance, but just to give you a sense that even our Optal portfolio, the overall margin profile will be probably higher than our standalone domestic business current margin profile as well. So that gives you an indication of what the margin boost will look like.
Okay. And
on the ESOP charge, we see that the balance charge which is left is approximately 47 crores, and the year till which it will be charged is FY 27. However, very clearly we see 10 crores getting charged in quarter 3 as per quarter 2.
Okay, 47 crores for this year you are saying?
47 is the total remaining charge. 47 is the total remaining charge.
Okay,
Yeah.
and in FY27, how much will you charge it?
So in FY 26, we see clearly around 20 crores and balance 27 crores will be in FY 27.
Okay. And one last question on the inventory days. In the presentation, you mentioned that the inventory levels have been increased. So, will it get normalized at the end of March quarter, or it will remain elevated only to build your Optal inventory and also, just to mitigate the risk of high API costs?
More or less, we will continue with the same levels of inventory. Given our Optal portfolio, currently is imported, there are certain times in the year when you see a slightly increased level of finished goods inventory, but no real major concern of inventory levels going further high from the current levels. It will be range bound from what you have seen in Q1 and Q2.
Okay. So, more or less, it would remain at the similar level of H1, FY26.
Yeah.
Okay. Thank you. That's it from my side.
Thank you. Before we take the next question, a reminder to all the participants, you may press star and then 1 to ask a question. Our next question comes from the line of Gaurav Bhama from JM Financial. Please go ahead.
Hi, good afternoon, sir. Am I audible?
Yes.
To begin with, sir, congratulations on a good set of numbers, and thank you for offering me the opportunity to ask questions. So I just wanted to understand the high single-digit growth expected in second half. Is it for the overall international business or just for the international formulation?
Overall business.
Overall international formulation business, right, sir?
Yeah.
That's all from my end, sir. Thank you.
International formulation business. Hello?
Thanks.
Yeah.
We'll take the next, sir.
Sure. Participants, you may press star and then 1 to ask a question. Our next question comes from the line of Abdul Qadir Puranwala from ICICI Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. The first question is pertaining to the ESOP charge. So clarity as to, what is this charge pertaining. Currently, there has been some buyout already. And at what price is this ESOPs been issued?
Narayan, you want to take it?
So basically the charge which we see is in quarter 2 is around 10 crores. And as I mentioned earlier, we continue to see that charge of 10 crores even in quarter 3. And the ESOPs which have been issued has been issued as per the rates which were governed and at the SPA, shared, not as per the agreement which has been signed by each of the employees. So I think it's at different rates for different employees. So some of our key leaders have been given ESOPs at different rates. So it is as per the agreement with the employees. is different for different employees. I hope I was able to answer your question.
Yeah, thanks for that. And second one is on the India business. So on the acute side, I heard the comment about the season not being that favorable. But sir, could you just help us understand, why there would be a dip in this portfolio in QT?
There will be, sorry?
So was there a dip on this portfolio? Because when you talk about a chronic growing at 20%, your overall growth was at 9%.
So what we maintained was that the key brands in chronic grew at 20% plus, right? And mainly because of the acute season being slightly muted, our key legacy brands, Rantac and Metrogyl, have shown slightly muted growth trends, and that is reflected in the overall number of 9%. Having said that, if you really look at the overall volume growth numbers for the IPM and for us, IPM volume growth for Q2 is just around 0.3%, which is again a reflection of the muted season, whereas our volume growth internally is 4% and externally also is reflected at 3%. So whatever dip you are seeing, majorly in some of our two large brands of acute and overall reflected in the acute portfolio, is a function of how the market has behaved.
Got it. Thanks for that. And just one final one, if I may. So on the CDMO business, are we still holding on to our previous guidance of 12 to 14% growth this year?
Yes, we should be able to maintain that growth momentum. If you look at the quarter growth, as Nikhil mentioned earlier, we grew at 20%. Our H1 growth also currently is looking at 14%. So we continue to, see the momentum being driven forward also. And we should end the year with close to 12 to 14% growth for CDMO.
Sure, sir. Thank you.
We have just two thanks, Abdul. We have two questions which have come in on the wall. One is on the Opthal segment. How do we see the performance of the Opthal segment in the first half of this year?
On the Opthal portfolio, the overall momentum which we were able to drive because of prescriber expansion, we continue to see good results coming as a result of that. If you look at the overall MAT numbers for the Opthal portfolio in our covered markets, we have grown at almost 16%, whereas the market has grown at close to 8%. We have already hit a monthly run rate of close to 17 to 18 crores, and we will continue to drive that going forward as well.
And Opthal, couple of new launches also we have done organically in the area of trials, which also is showing a good traction, and our coverage overall also has improved in the world of ophthalmology with the doctor community, which also is helping us to improve the prescriber base.
Right. The second question that we have is, what is going to be CapEx for the entire year?
CapEx for the entire year, as mentioned earlier, also will be close to 100 crores. We have always maintained that our maintenance CapEx is in the range of 60 to 65 crores. There is greenfield CapEx, and this year greenfield CapEx was largely attributed to the new IV line, which is also going to get commissioned within the next 2 months. So major part of our greenfield CapEx also has been absorbed this year.
And the last question which has come in, you've seen some growth in the API business. Any views on that?
So we want to maintain a quarterly run rate of 25 crores on the API side. H1 has been good so far, but as we have always maintained, it's not a function of any new launches. As far as our API business goes, we want to maximize the market with our current portfolio only, and rather actually focus on API units serving the captive requirements, and that will continue to be the focus going ahead as well.
Yes, we can go back to the queue. Thank you.
Thank you. A reminder to all the participants, if you wish to register for a question, please press star and then 1. Our next question comes from the line of Neelam Punjabi from Perpetuity. Please go ahead.
Yeah, thanks for the opportunity. My first question is on the MR productivity. So you mentioned it's at 6.7 lakhs. So what's the target for this productivity level over the next couple of years, and at what level would we then evaluate the add to our field force?
So Neelam, just to correct you, the productivity trending this year is 7.5 lakhs, not 6.7.
All right, my bad, sorry.
Yeah, and that is what we had guided also. So we have taken an internal aspiration that we would like to at least touch 8 lakh rupees productivity, which will be a good productivity for the portfolio mix that we have got. And by that time, at least we will think in terms of if we want to add the field force on the ground. That we had guided earlier.
Got it. Okay. And my second question is on the international formulations business. Could you provide a breakup for the first half in Brazil, South Africa, and US? What's the revenue split between the three?
We don't provide a breakup of geographies, Neelam, but just to give you a broad sense, in our key markets, Russia, CIS continues to perform well. South Africa and US were slightly muted, but given the order situation, we see the trajectory changing there in H2. APAC is on a good track as well, and that will continue to be parts of our key markets, and that's how the trending will happen.
Got it. That's it from my end. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Nikhil Chopra for closing comments.
No, thank you all for coming for the investor conference for JB. And we continue to outperform the market, particularly what is happening in Indian pharma market, growing at 300 to 400 bits better than the market. A lot of market projects are on in the world of CDMO, which will help us to drive mid-teens growth for CDMO business. And as communicated, right now our India plus CDMO contribution is close to 70%, which will only go up to 75% to 80% in the coming time. And that will help us to drive better EBITDA margins and continue to guide the street in terms of any revision that we want to do in terms of our gross margins as well as EBITDA margins. Thank you all once again. Thank you.
Thank you. On behalf of JB Pharma, that concludes this conference. Thank you for joining us, and you may now disconnect your line.